Within a long-term uptrend, a series of precise levels run through several gap ranges and clear swing points, some of which are part of familiar patterns, to provide highly valid ranges to reference. These are precise levels because they are round numbers and still stay very close to the open, high, low, and close prices of gap candles and key swing points. A strong uptrend as shown by gap ups that aren't immediately filled. The 2714 to 2640 gap up fill range just misses being filled completely during late 2016. Nonetheless, close proximity to the gap fill zone and double bottom reversed to continue the long-term uptrend. This demonstrates a minor imperfection from theory to real chart price action. It would have been good to see the double bottom form upswings right in the 26 to 27 range, but that is a minor detail overall given the clear support that formed to end 2016. A sharper peak is formed at record highs, due to the gap up candle being a bearish star. That is immediately confirmed with stronger closes under its low. A narrower gap up range is drawn directly from the bearish star's open and close prices. The gap fill area is roughly from 40 to 41, but to be more precise, most attention is focused on 40.50. This is a nice round number that is close to the open of the candle just before the gap formed, and near the opening prices of the previous 3 candles that outline flat price action before the gap. It would be unrealistic to always have results like this, where the low of the gap fill upswing forms almost exactly on the single gap fill level. It is possible to have results like this, but less common to have such precision all the time. Using the wider 40 to 41 range would have been adequate and would have encompassed the more easily referenced downswing that began 2018. If a single price level was preferred, using the closing price of the candle just before the gap up would have also been adequate like in most gap examples. It made little difference here since 40.50 was a nice round number and the candle before the gap up had a small real body. It should be noted, this gap up was mainly from the market's reaction to an earnings report. That is why there is the familiar indecision that precedes the gap up in late January. Gap fill support remains strong, but selling pressure is increasing, and the lower March 23rd close adds to short-term bearish sentiment, increasing the possibility of a break lower in the near future. Using a wider support range similar to the proposed 40 to 41 range in early 2018 provides a more comprehensive outline of the wider support range. The 40.50 level still remains the focal point of short to medium term bearish contention. The breach of gap fill support would have likely been completed before April began, if March 23rd had higher volume, similar to what was seen in the last 2 days of February. In addition to the less overwhelming bearish close on March 23rd, selling pressure has remained sporadic with a few volatile red spikes, rather than constant selling for several days with above normal volume. These details contribute to the delay of the downtrend's progress into the 30s. The small gap up on April 18th is not much of a bullish reversal, as it begins to face immediate resistance from the descending trend line, and the gap up candle was already bearish, being a large red candle. The broader context of overwhelming bearish price action and volume prevails, and this current gap down cements a more decisive break under the 40 boundary, compared to the initial lower close on March 23rd. The downtrend certainly continues, but too much fixation on major short-term volatility can throw off this observation. Overall, there was price action similar to a descending triangle, but no strict descending triangle formed due to the major price fluctuations from late March to the present. This provides a great example to show decreased precision due to major volatility, and the importance of keeping in mind the broader context in addition to short-term developments. This could just be treated as a regular downswing, reusing the 40.50 to 39.85 range as the gap fill range. Even if the triangle outline was expanded using the upper trend line, the pattern was invalidated due to the premature break of the support base. The solid lower downtrend line is theoretically more sound, since downswing points with higher volume have their real bodies contacted by it. However, as mentioned before, flexibility will often be needed with trend lines from chart patterns. The upper trend line from the highs of downswing points is also valid, but theoretically slightly less influential. Obviously, here in practice, both trend lines are highly useful to highlight why theory shouldn't always be strictly adhered to, and the importance of flexibility that will still adhere to plotting valid support and resistance, trend lines, levels, and ranges. It would be more accurate to say the descending triangle was invalidated to an extent rather than saying it was a failed descending triangle. After all, price action was still generally contained within the downward trajectory of the triangle. The various descending trend lines that expanded the triangle also defined a very accurate sloping resistance for minor upswings in the overwhelming downtrend. The downtrend lines are crossed during a double bottom reversal that uniquely has a gap before and after it to accelerate the transition from down to uptrend from late 2018 to the start of 2019. The current gap fill is proving to be quite weak as it is gradually being breached. At first it seems unusual given the overall low selling volume from May. However, when put in the wider triple top range that has seen major selling pressure since March, the decline is perfectly within reason. June starts with a red spike to increase the chances of a larger triple top drop. Selling pressure never returns to sustainable levels like in early March and April. Instead, there is an excellent example of a failed triple top that seemed highly likely to succeed. Gap fill support held to provide a large flat bottom within the horizontal range that can become a resting phase in a bullish continuation towards the prior 39.85 level. General 3 methods rising price action completes the bullish continuation, to finally return to the 40 boundary where there is the expected return of resistance and volatility. Interestingly, the failed triple top had higher red volume for most of its early duration. This is somewhat unusual for a horizontal resting phase in a classic bullish continuation. It is not surprising eBay has fallen again due to the long-term resistance range being such a clear landmark. Even if the minor upswing is able to return to the range, it is likely to face strong opposition. The 40.50 to 39.85 range still slows down an aggressive uptrend in 2020. Bearish reversals from July to October 2019 did have an impact, in that they expended most of the medium to long-term selling pressure at this range. When there was the early 2020 uptrend, selling pressure remained, but at far lower levels. The 46.99 all-time high seen near the start of the example enhances the detail of the mid-40s range reversing rolls from previous resistance to crucial support as eBay makes progress in establishing stock price into the 50s and beyond. This also reiterates why candle patterns are an important component used in chart pattern analysis. Candle patterns usually summarize shorter-term developments, while chart patterns summarize more medium to long-term developments. So the two are complementary to one another. Improving candle pattern analysis can definitely help chart pattern analysis.